So just a review of corporate entity. So what are the major characteristics? Number one, it is a separate legal entity. Okay. So just like a person, it can own property, it can break the law. Usually, now there's since 2000, Sarbanes-Oxley, I think it was 2003 or something. The CEO, actual people can go to jail, but also companies can commit crimes. Um, but again, the big thing is owning property, being able to conduct business just like a person. Okay, but the person, the shareholders, the owners of this corporation aren't personally liable for anything. Okay, so this corporation is a separate person. You can think about it like that. But unlike a person, a corporation can live forever. Um, it it has no physical form. It's like a legal thing, but from a legal perspective, it has many of the same rights as a person does. Secondly, you can have many shareholders. Okay, uh, there could be thousands or millions of shareholders for a corporation. Other simpler forms of business don't accommodate that. There's like sole proprietorships where there's only one owner. Partnerships are typically limited in the number of partners there are. But a corporation, a key factor is that the shareholders are numerous and they don't necessarily need to know each other or have any affiliation with each other. Yet they're all still connected through their joint ownership of the business. Um, no personal liability. This is a big one, okay? Because shareholders, they're more likely to take a risk on a business if they know exactly how much they can lose. If you're investing in a business and not only will you lose, like, let's say the $100,000 you invest, but they could come after all your other assets, you may be reluctant to invest. Okay, so the fact that your loss in your investment is limited to how much capital you've put up and nothing more than that, it encourages people to take more risk. Okay, so this is a key feature. Uh, there were times where even your family members, okay, this is like a very un-American thing, but there are some advantages we could even talk about where, let's say your brother took out a loan and didn't pay it back. The moneylender could come after your whole family for the money. Okay, so uh, that that not only are you limiting your liability, or like there's infinite liability for you, but also your family. You got to like watch out for what they're doing. This is a big innovation in risk taking. Okay, um, to have this limited liability. It's not just a trivial thing. Lack of mutual agency. So basically, if you're an investor, if I own one share in Tesla, I can't go to some warehouse and be like, "Hey, I'm the owner of Tesla. I can let me sign a lease on Tesla's behalf to lease this warehouse." Okay, only the managers who are delegated those responsibilities on behalf of Tesla are able to do that. So even if you own 50% of the company, if you're not a manager, if you're not um, part of that organization that's like given those abilities to bind the company, you can't do it. Okay. So that also protects the business, it protects the shareholder, because if you're a shareholder and there's some other shareholder that's like reckless, that shareholder can't just do whatever they want with the business. It's only whoever is actually managing the business and has been deputized with those responsibilities. They're the only ones that are able to bind the business. Okay, but this is different. A partnership, one partner can bind the whole partnership to something. Okay, so again, these features are very important in why a corporation is like the de facto entity that businesses kind of operate under. Okay, I mentioned this indefinite life. So the corporation can outlive even the founder, right? J.D. Rockefeller, he founded Standard Oil, is the first like mega corporation in America, you could argue. Um, and it continues to live. The shareholders, it's not, there's no Standard Oil anymore, but pretty much Chevron, ExxonMobil, these are all spin-offs from Standard Oil, okay, because it had a monopoly and they were forced to split apart. But if you own shares in Standard Oil, I bet, I'd have to verify this. You could fact check me, but you probably would still own the corporations that are around. Like you'd own some Chevron, some Exxon, some whatever. There's some other oil companies that are spun off from that. So your ownership would have been split. So, but it would continue to live. Okay. There are some corporations that have been around for hundreds of years, and some of them are probably privately owned, but the shareholders still, they still retain ownership in this valuable entity, and their heirs get it. You can pass on your ownership to your heirs. Taxation. So one disadvantage for large corporations is that the corporation, because it's like a person, pays tax, but then you as a shareholder are also going to pay tax. In which ways? Well, if the corporation pays you a dividend, right? That is cash that is available for the business, but it's from, hopefully profit that the company's made and they've paid tax. So that dividend is like a post-tax distribution, okay? So the corporation pays tax, they give you a dividend, but you're as an individual going to pay extra tax on that dividend you receive. So this is a big disadvantage for American corporations. There are some countries that don't have this, that they understand that the corporation was taxed, and so the individual should be able to get their distributions tax free. But in America, um, it's taxed, the dividends. Also, if you own shares, and you sell the shares for more than what you bought it for, you will pay capital gains. Okay, so there's a lot of criticism for like the billionaires, right? Bezos, okay, for example, he has many billion-dollar net worth, but it's all in this stock, and he's only going to pay tax on it if he sells those shares. In which case, he'll pay size, a large amount, but he's just not a seller, so he doesn't have to pay tax on it. And Amazon, I don't think pays a dividend, so he's not paying tax. His business has paid a ton of tax. They paid corporate tax, property tax, payroll tax. It's not like Bezos isn't getting hit with the tax bill somehow. It's just his shares, his ownership in the equity interest of the business is not being taxed. Okay, so this is uh, a key thing to understand. Without him, Amazon wouldn't exist. All the taxes that come from all the employees, all that wouldn't be there. So I think we have to be a little nuanced in our understanding of corporate tax and the taxing of very wealthy people. Okay, it's not as straightforward as maybe politicians and journalists want to make it. I'm not saying that I'm not trying to defend, but I don't think that if you just watch media and like listen to politicians, you're not getting the full picture. So hopefully you're now going to understand something about business and business entities and understand that actually they do pay a lot of tax. Okay, so any questions on taxation or anything I've talked about? I guess let's just cover this last one. Capital accumulation. As we see, a business corporate entity has retained earnings. So whatever profits it's earned, yes, it does pay tax, but it's able to retain all that capital and then reinvest it in growth. Okay, this is kind of like what you could argue this is a key form of like the capitalist economy or capitalist mindset. If you're given $1 million, most people are not going to say, well, I'll distribute it to my friends and family or give it away or whatever. They'll probably be like, I'm going to save it or I'm going to invest it, right? That answer is coming from a mind that has grown up in a system of economics where this capital accumulation happens. When you invest your money and you get interest, that interest is not just coming from some tree, right? Some magic money tree. It's coming from business growth. It's coming from these companies creating value, creating new products, expanding into new markets. It's all coming from this capital accumulation. Okay, so we are all participants in this. Our 401ks, our pension funds, our savings. When we put money in a bank, the bank is lending money. It's all fueling this system, and we have such a high standard of living because of it. And of course, it has downsides a lot, but it also has tremendous benefits that we're all kind of benefiting from. Disadvantages, uh, ownership and management are often separated. So the the principal agent problem, okay? This is a huge problem in economics where the person that owns is different than the person that manages. Or the person that's representing you has different interests than yours, right? Like a sports agent, for example. A sports agent represents an athlete. The sports agent is compensated on percentage of the contract or whatever, right? So that's not always fully aligned with the athlete. What if if you're some athlete and I don't know, OnlyFans wants to sponsor you, okay? Maybe they're going to pay you a lot of money, but your brand is maybe not is going to get hit, you know? Maybe you as an athlete don't want to do that because it's like, it's like it's like kind of a seedy company. But your agent might be like, well, they're getting 10% of that, so they may push you to do that, right? So this is a classic problem. I don't know if it's in this class, someone said, well, aren't there corporate laws about corporations have to maximize profit? And that's like a bad thing. It's largely a protection against principal agent problem where the managers of a business may have other interests that diverge from the shareholder. Maybe they want to promote themselves. Like you see Elon Musk, he happens to be the controlling shareholder and the CEO of Tesla. But he does a lot of self-promotion stuff with his companies, and that could be to the detriment of the shareholders. So what those corporate profit maximization rules are is to not allow the agents of the business to screw over the shareholders. Okay, so that's one big problem. Double taxation, we talked about that. Um, Government regulation of corporations. So it just costs money to run your corporation. You got to pay various regulatory things. You got to there's certain rules of managing the corporation, operating it that you got to pay for. And then there's startup costs. So when you first incorporate, there's going to be some expense and time that goes into that. Okay. All right. Any questions on this? This is like it's very important to understand both the pros and the cons of this. This is what our whole economy is built on, these corporations. And you may start one too, right? The startups in Silicon Valley, they're all, if they're taking venture capital, they're all incorporated as Delaware S corporations or C corporations. Okay. And that allows them to take in capital, right? They can bring in new shareholders. Um, Delaware has a very uh, developed legal structure for resolving any corporate disputes. That's why it's the state that's preferred for a lot of corporations. Um, so understanding this stuff is important in your business kind of general knowledge. Yeah, I was just saying, not only are the big corporations that we think about corporations, but even small startups, they're corporations too. So this structure of business using a corporation is prevalent through all levels of our economy.